Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. Okay, great. We are live here. I'm excited about our next guest. It's going to be talking about venture and about innovation and also the consumer space. So I want to talk a little more about some of the highlights of what Matt has been building with his firm and his team. And, just to give you a brief overview on Matt, Matt's a managing partner overseeing activities at the Ember Fund. And he's recently served as an interim CFO for Steve Allen. And he's also in the past worked at he was an investment professional at AEA Advisors, supporting PJ Solomon and Deutsche Bank. And he's worked with a lot of brands. So I can see why he's added a lot of value to this team. Some of the brands that he's worked with has been PVH, VF Corp, Victoria Beckham, Citizens of Humanity, Drybar, Tribe Dynamics, and Jure. And he went to school at Georgetown. So that's kind of a couple of the high level bullets. But Matt, excited to talk to you about your background, how you broke into venture capital, and kind of some of the exciting things that you're doing. So maybe you can start with your early career, where your family's from, where you went to school, and then kind of how you transitioned with some of these different, switches in your career to the Ember Fund. And then we'll kind of dive deeper as we go.
Great. Yeah, Joel, thanks for having me. I was going back to the beginning. I was born in New York, but grew up outside of Philadelphia in an area called Bucks County. Went to college at Georgetown, where I studied finance and international business. While I was there, basically worked all 4 years at Banana Republic and kind of paid my way through school. So just kind of sparked an interest in the consumer space, starting in the apparel sector. When I graduated, I got a job at Deutsche Bank, actually working on the credit side of things, where I learned that cash is king, and that kind of tracked with me through my career and what I'm doing now, which is a different twist on venture. But spent a short stint at Deutsche Bank and then went over to a boutique retail consumer M&A investment bank called, at the time it was called Peter J. Solomon Company. Now it's called Solomon Partners, but very focused on retail apparel. Did deals like the PVH deal with Warnaco, Tommy Hilfiger, Citizens of Humanity, companies that are mid-sized to much larger businesses. And really learned a lot about the retail consumer space there. Afterwards, went over to AEA Investors, where I worked on the credit side for about 3 years, helping on the investment side across the capital structure. So investing in everything from senior debt all the way down to subordinated debt, mezzanine, and equity co-investments. So worked as a generalist across a lot of industries, but always had the itch to get back into consumer. So when I left AEA, this was in the late 2000s, sort of probably middle of the financial crisis. Found my way partnering up with a couple of former retail operators who had built retail businesses, companies like Body Shop, Swatch, Seven for All Mankind Jeans, Lucky Brand. And we started working together to invest in small up-and-coming companies and brands and consumer businesses. And also built out a consumer advisory consulting business as well. After a few years there, I met my now partner and co-founder, Avani Patel, who had actually started the first fashion accelerator in New York called Trendsetter. And we realized we were just kind of doing very similar things where we wanted to work with founders and be part of the early stage ecosystem. Mm-hmm. And we decided to put it together, and about 7 or 8 years ago, teamed up. and co-launched Ember. And the original model for Ember was actually kind of similar to an accelerator, an incubator. We would take on very early startups in the consumer space, whether they were brands or technologies. So, brands like Notum, technologies mine, that we would provide them access to a pretty strong network of
Hmm.
advisors and experts, former founders or current
Yeah.
CEOs and executives, a lot of investors, and we would do all that in exchange for equity. And that's a model we still deploy today, where it's sort of a value add, taking on advisory shares for equity. And as that portfolio grew and as we were kind of building out our network within the consumer space, we realized that a lot of the companies that we were talking to all came across the same problem, which was they would get to a couple $1 million in sales. And one of the biggest challenges to getting from, single digit millions to double digit millions was simply funding the inventory to do it.
Hmm.
And so myself and our other partner, Luke, who had worked with me at AEA, kind of came together, and we realized there was an interesting sort of credit product that we could introduce to market that would solve that problem for small, high growth brands. And so back in 2016, we launched Ember Fund, which is sort of a hybrid venture credit equity platform where we give all of those founders and companies access to the same network. We now have about 500 or so advisors or experts that volunteer to help our founders and companies in all sorts of different ways.
Hmm.
And then we give them sort of a debt facility that helps fund working capital, with the idea that can sort of spark a nice flywheel of cash flow, discipline, and generation that can take a company from single digit millions to double digit millions. And so we've been doing that. We're now on our second fund. We've done over 30 deals across the platform. We have
Hmm.
an additional 35 to 40 companies on the original advisory equity platform, and we have a consulting business that helps companies, large and small, think about innovation, digital transformation, strategic growth, all sorts of different matters, where we pull in that network of experts and kind of put teams together to help companies in all sorts of different ways.
Yeah. That's a really great overview. There's two questions that I'd like to have you educate us on. Number one, you mentioned in your early days, kind of working in credit, that cash is king. So maybe you can kind of unpack that a little bit. And then number two is, there's a lot of different communities, there's a lot of different fund structures. So, can you just break down the difference for the audience between a credit fund versus a debt fund? Or are they the same thing?
Yeah, yeah.
Are there little nuances between the?
I'll start with that.
Yeah.
Credit and debt, basically, they're the same thing, so just
Yeah.
different terminology. I would say what we do is a little bit different in that it kind of sits outside the traditional private debt world or
Yeah.
venture debt world, where there's components of that, but also,
Mhm.
we're just taking a very different approach, where we sort of lead with the idea of how do we add value to these businesses through our network, through our resources, through the partners that we have. And then the debt component is almost I wouldn't say sidelined, but
Mhm.
an interesting way for us to engage with the companies on the financial side.
And then can you just share a little insight in terms of your comment about cash is king? Is it just because the companies are just really utilizing the cash to just scale their business, and that's why it's king because
Yeah,
it
I
helps them get
mean,
to where they need to be?
I think by nature, credit people tend to be a lot more conservative, right? That their
Yeah.
goal isn't to have sort of create outsized venture returns; it's to get
Hmm.
their money back
Yeah.
plus maybe some interest.
Sure.
And in order to do that, you sort of have to focus very much on the fundamentals of a
Hmm.
business. And there's the venture formula of growth at at the expense of potentially profitability,
Yeah.
which oftentimes makes sense for a business.
Hmm.
But for us, part of what I learned early on is really honing in on fundamentals.
Mm-hmm.
When you kind of get a little bit more academic about it, the value of a company is the present value of its free cash flow, and
Mm-hmm.
free cash flow is based on how, can a company be profitable? What are the margins? What are the unit economics? And when does that happen? So
Yeah.
I think there was a broad expectation and in the market when there was a lot of venture dollars flooding into the
Mm-hmm.
consumer space that it made sense for companies to take that money and grow as fast as possible.
Yeah.
I think we've tried to be as disciplined as we can with our portfolio in making sure that the companies that we do invest, even if they took on that mentality, there was a clear path to being profitable, and potentially ratcheting down the growth so that the companies can get there. And then we have a lot of companies that just kind of skip the venture
Mm-hmm.
uh, treadmill altogether. So some bootstrap businesses and companies that raise very little capital and rely quite a bit on the debt funding to get where they are.
Yeah. Yeah, that's really interesting. So I would say on the when you look at venture debt, I feel like they could probably be a partner to be downstream from you, right? Because venture debt, the way I look at venture debt normally is, your company is doing pretty well, you got repeatable revenue, but you could use about $1 million of just quick capital to be able to maybe double down on your ad spend to get your revenue maybe by maybe doubled by 2x to hopefully get to an attractive level to get your next funding round. So it's kind of, I've seen it used as like a bridge between maybe your seed two to like your seed, your series A. And maybe there's some benchmarks or KPIs that some lead investors have expressed saying, look, you need to get to $1 million in ARR at least. And um, would you say that could be a possible complement to your strategy, kind of partner with some of the late stage venture debt
Yeah.
people to kind of get people a little more capital to scale?
Yeah, for sure. I mean, we're a pretty small fund, and so if we're doing what we're supposed to be doing right,
Mhm.
the companies will obviously grow, and
Yeah.
we found an interesting niche, with
Mhm.
companies that are doing single digit millions in
Yeah.
revenue, getting them to double digit millions, where
Mhm.
the need for additional capital and larger check sizes is certainly present. So we've definitely our portfolio has definitely benefited from that, and
Mhm.
we've seen them. We've sort of passed on opportunities to larger debt providers in that space. So it is a very symbiotic relationship, and we like where we're playing.
Mhm.
We're not trying to get too large from a fund standpoint, because we really like working with these companies that are at the stage that they're at.
Yeah. And to translate what you were saying earlier, cash is king. I think you made a good point because when I was thinking about cash, I was thinking about the portfolio company just getting cash to buy more inventory and be able to have those products to sell. But to your point, the LPs, a lot of the larger institutional LPs that I've interacted with, a lot of them are looking to get into opportunities that spread their assets much wider. So they have a multi-asset approach. So they may do some early stage investing to take advantage of the power law, but having a more conservative approach where there's predictable, returns in some type of private credit strategy could be helpful as well. I guess my question to you is: have you seen that same sentiment from LPs and just kind of like the fund managers providing different types of options? I've seen some large funds that are on like their fund five that have like five different funds. One is like an early stage fund, one is like a cross border fund that's only late stage and growth equity. So, what are some trends that you're seeing with kind of funds that maybe you look up to that are being more mature, and then kind of the appetite of what LPs are looking for?
Yeah, and I think the general trend just within private credit is growing. A lot of this came about after the financial crisis,
Yeah.
back in 2000, late 2000s, where, the banks sort of disappeared and private
Mhm.
credit funds sort of filled that void. And so we've just seen that trend continue. Venture debt funds doing very well, and I think from a risk reward standpoint have shown really strong returns. with relatively reasonable, if not low, default rates. And so I think it's, as an asset class, it's super interesting. There's certainly larger investment organizations that have diversified into various pools of capital, like credit and equity and different stages of companies that they're investing in. And we certainly have some ambitions to do something similar, but in terms of what our core strategy is, this sort of flagship debt equity hybrid has really kind of worked for us. And something that we continue to plan on pursuing the way that we're doing for at least the medium term.
Yeah. And I've seen a few people in the marketing space do like a consulting model where they do consulting for equity, and I thought that was really interesting. Where you could probably add a lot of value and maybe reduce your retainer price, and there's a big difference in cash now versus equity. So
Yeah.
and one of my favorite examples that I think of, I don't know if you saw the Michael Jordan movie Air, talked about like Michael Jordan and how he got involved in the development of Air Jordans. And one specific thing that his mother made sure happened was that Michael Jordan owned equity in the sales, not just the top line commission of the sales, but that underlying power of just owning equity. And as we both know, some of the biggest wealth has been generated from equity versus just flat commission and sales. So I don't know if you have any stories on just kind of equity, maybe with your portfolio companies or just other examples, but that's one that just comes to mind.
Yeah, I mean, that's why we started the business. We thought that there was a really interesting and untapped opportunity to add value to a lot of companies in a meaningful way.
Yeah.
And build a portfolio of essentially advisory shares and sweat equity where we really earned it. And I think a lot of former executives kind of fall into a trap of taking advisory shares in a few companies and having it not work out, but oftentimes don't take a portfolio mentality to it, and that's what we did. So we kind of constructed that portfolio. We tied it into the fund that we raised and are deploying, and that all benefits our investors. They essentially get upside in all of these businesses with little to no risk. And then obviously there's a credit component that layers on top of that. So we see it. We see, at least on paper, and in a couple instances in cash, of that working out. And so feeling pretty good about the model and the opportunity that it presents.
Yeah, I'd love to also just double click on some of the types of companies that you're interested in. So consumer could be a pretty broad industry. So there's beverages, there's CPG. So can you just unpack the landscape of what you guys are looking for and what you think is exciting? I mean, I when I think about it, what excites me is these creators, these people that have large audiences. They come up with a product, and it's usually a product that resonates with who they are, and then that product, they can kind of share that product with the audience, maybe test it out, get some feedback, and they don't have to pay for marketing. They have their own audience to drive traffic to those products. Obviously everyone's talking about Mr. Beast and the Beast Burger, and he's got chocolate bars. So what are you excited about when it comes to the type of portfolio companies that you're looking for?
Yeah, I mean, for us, obviously there has to be a diversification element to it. So we look across the consumer sector, mostly in brands, but sometimes retail technologies. That support the ecosystem and the digital growth of things. I would say the overwhelming focus for us, that is consistent across the companies that we're looking at, they're all value based and sort of have a better for you, better for the world element to them. And so a lot of the stuff like sustainability, for example, it's just something that we don't necessarily market it this way, but essentially, we view it as table stakes. And so our almost our entire portfolio has elements of sustainability or focused on it. And then, we're within consumer subsectors, we're pretty agnostic. So we do everything from apparel to home goods to personal care. We do a lot in health and wellness and beauty, CPG, food and beverage, and we see opportunities and pockets of opportunities in all of them. I think today, for example, there's been a pullback of, particularly on the venture side, away from apparel. But we think there's interesting pockets of opportunity there that where sort of a new generation of interesting apparel brands will come to market, and it might be a compelling time to be investing there.
Why do you think there's been a pullback on apparel?
I think a lot of it just has to do with the lack of exits. That there just hasn't been that many successful exits in the apparel space, and a lot of money went into it, and so particularly from venture funds, there just isn't enough upside and not enough winners out there. So I think there's definitely hesitation there.
Yeah, no, that makes sense. I mean, I saw a really amazing episode from the Hassan Minaj show on fast fashion. I don't know if you saw that, but that was pretty mind blowing. I think it's Zara. Their whole business is like taking luxury brands like Bonobos or what's the other one? I forgot which one it was. Balenciaga, and like kind of having a similar style. And the clothes are so cheap that people will buy them, and then even if it goes bad, or the clothing fades away, they can just go out and buy a new one. But the problem that it's creating, and you touched on this earlier, is just the massive landfills that occur as a result of that. So if there's ways that people can upcycle those, I know Fubu was doing that for a while. Damon John, that was one of his businesses. I think like upcycling it and selling it to third party markets like Africa and some of the other countries that would still use the clothes. So I don't know what your thoughts are on like just fast fashion. Is that an opportunity for some new startups to come out with like just kind of a cheaper t-shirt for people to wear? And I have to say too, like I bought a pair of jeans from Amazon. Like Amazon Essentials has like these slim fit jeans. They're like $20 and they fit like perfectly, and they've got like blue, black, light blue. So I see Amazon also coming into play, just taking standard essentials that like a typical person would wear, and kind of democratizing that as well.
Yeah, I think that there's almost no barriers to entry in fashion, right? Like you can spin up a fashion brand, within a couple weeks probably at this point. There's definitely winners out there that Shein, and based in China. There's a lot of fast fashion out there. And I would say that the overall sentiment of wanting sustainability isn't necessarily matched by how people spend money. And so I'm not sure where that's going. But for us, we do believe in the overall long-term trend of sustainability. So when we do invest in the fashion brand, we want to make sure that supply chain has been figured out. We do think there's a lot of opportunity to invest in supply chains, so away from brands into some of the technologies that may make upcycling and recycling possible, because the world needs it. The industry needs it, and I think it's one of the top 3 polluters from a carbon standpoint, industry-wise. And so there's a lot happening in that world, and I would say some investment dollars going in to solve those problems. But there is a little bit of a hesitation on the brand side and fast fashion. Maybe it exists. I haven't seen sort of someone doing it in a sustainable way that makes sense, but we'll see. I'm sure people will tackle it. So
And what are some of the other sectors? So you mentioned CPG, and you also mentioned beverages and food. So what are some hot trends that you're seeing in those areas? Are people still really involved in plant-based products? Is that kind of a hot CPG food item?
Yes. I think with like Oatly having so much success, but I think in general just health and wellness, better for you products are and another industry where there's very low barriers to entry, and so we see a ton of them. It'll be really interesting to see what happens with the economy, to see how many of these guys survive.
Mhm.
And we're sort of tracking to see how the retailers react to it, how much shelf space becomes dedicated to some of these newer brands and newer categories relative to what the incumbents are doing. And then, how do the large incumbents think about
Mhm.
acquisition partnership, or trying to compete their way on the shelf, because ultimately there's limited shelves,
Mhm.
and then you kind of go to Amazon and online. So it's a really interesting time, I think, to be investing, but we do think that the general trend towards health and wellness, whether it's on the food side or
Mhm.
beauty, personal care, general nutrition, is something that's growing, and people are just spending a lot more share of their wallet on that and travel
Mhm.
relative to apparel, for example.
Yeah. What are, one question I have from the founder side, if I were to start a beverage company or even just some type of CPG brand, because the way you explain it, it's like, wow, it's easy. You could just like pop up a brand in like a couple days. But, what are the regulatory things that I need to think about? Do I need to have like approval from the FDA if I'm launching a beverage or a
Um,
food, like a food item, or what, you
yeah,
know, can you unpack
no,
that a little bit? Oh, you don't? Oh,
yeah,
wow.
I
So if I
think
were to
that,
launch some type of like watermelon juice, I could just
yeah, a lot of that would have to do with the claims that you're trying to make and your
Mhm.
ingredients, but you can
Yeah.
certainly launch a brand without FDA approval,
Okay.
depending on what it's made of and how you're
Yeah.
talking about it and marketing it.
Mhm.
So um, it,
I didn't
it,
know that. Yeah, I thought there was a whole like like regulatory barrier that you had to get approval on before launching.
I don't think it's anything major. Oftentimes some of these businesses start out of someone's kitchen and then
Yeah.
into like a test kitchen, and so it's not a huge barrier
Hmm.
to get started. And I think once you're thinking about scale, you want to address all
Yeah.
those things and make sure that you've gotten all the details
Hmm.
worked through. But
Yeah.
to get it going, it's relatively straightforward now.
Sure. And then same thing on the food side as well. Like if you got like some type of jerky or something, or um,
Yeah,
you
I
could do
think so.
that.
I don't think you have to go through any burdensome governmental
Yeah.
processes in a lot of categories.
Hmm. And you talk to a lot of these companies, you probably look at a lot of them that you passed on, you look at a lot of them that you're super high conviction on. So tell me some of the things that go through your mind when you're worried about a founder. What are some of the red flags that you constantly see, especially in the consumer space?
Um, I mean, I think maybe the biggest one would just be, um, putting a product out there that's not differentiated enough,
Hmm.
and relying on a low barrier to entry uh, differentiation point if they think it's differentiated. Meaning,
Hmm.
an example of that would be that there was a lot of brands that we saw that were focused very much on marketing the sustainability of what they do,
Yeah.
and maybe a couple of differentiation points on the ingredients or the brand, but nothing that we saw, nothing that we would see as like long-term sustainable,
Hmm.
from a defensibility and business model standpoint. So I think that it's one thing to be first to market, but then to kind of maintain that position and grow, it's a different set of challenges. So I think that's certainly one thing where if we don't see that interesting twist or element to the business model that we
Hmm.
find think can be defended, then that's when we'll tend to pass on opportunities.
Yeah. And then what about when you have high conviction on a company? Um, I'm assuming definitely they have the differentiation. What's some other pieces of the DNA that you've seen? I'm assuming definitely like some type of repeatable revenue machine. Where they have some type of system where there's leads that turn into sales
Yeah.
very quickly and repeatably.
Yeah, I mean, I think there's a couple of different ways that we look at it, because there's the, sort of the credit side of things, and then there's the upside on the equity. When we think about credit, it kind of comes down to unit economics and a lot of the fundamental metrics of a business, making sure that it can get to profitability, ensuring that the marketing metrics are attractive, sustainable, and correct, because oftentimes the calculations are wrong. But you're right. Just kind of thinking about recurring revenue from the customer base, but also from the same product offering that you have. So that's super. A lot of fundamentals there. And then on the equity side, it's sort of conviction in the founder. The potential for sort of stickiness in a consumer that is hard to take away. And so, once you've established that customer base, how long will they be your consumer for? Are there age group dynamics that come into account, or is this, a customer that you can have for 10 plus years? In for example, like the vitamin sector, where we have a nutrient business that we feel like, the consumers, once they're in, potentially in for years and years afterwards.
Yeah, what I've seen, and I don't know if this is the same thing on the consumer side, but what I personally think is powerful is the frequency of when you charge people for the subscription. So I've fallen for this too. I mean, I'm a multi-year subscriber of some software tools, but it's because they only charge me like once a year.
Yeah.
So it's a couple $100 a year, versus if they were charging me like 15, $20 a month, I'd probably be like, wow, let me think about my expenses. Maybe I should cut these 3 subscriptions because I don't use it as much. So I think also what's interesting is the pricing and packaging of subscription products. And I don't know if you've seen any experimentation with that, whether it's like a monthly pricing strategy versus a yearly, or hey, buy this package in bulk and we'll deliver some type of product to your door for 3 months or something.
Yeah, I mean, that's not my area of expertise, but what I would say is, I don't think that there's one formula that works for each company. I think it could be unique to each company, but it's also, how does that tie into the broader integration of brand and content and marketing and your consumer relationship and journey? That makes sense. So, there's so many variables before you get to that actual like cadence of subscription that you have to make sure are all integrated and balanced in a way that that works.
And I actually, go ahead. Sorry.
I was gonna say, and that takes a lot of experimentation and testing and just triangulating around something that works for each business model.
Yeah, no, I was gonna say, I have Hulu at home, and because I have Hulu, I have access. I watch the Shark Tank show, and they have a lot of consumer businesses on the show, so I kind of learn about a lot of the red flags when I watch that show. And one thing that I learned is, Amazon, like their ads are really, really expensive. So a lot of times if you're running, ads on Amazon, Amazon takes a very huge chunk of the profit. So what I see that founders struggle with is really their cost to acquire a customer, and then really kind of what's left on the balance sheet after kind of running ads and kind of all of their overhead. They're oftentimes not profitable. I mean, I've seen many of these companies negative revenue for negative revenue for hundreds of thousands of dollars. So for me, that's kind of what I've seen as a red flag. And then, another thing that I often see is just the lack of inventory. So they get a lot of it's a good problem to have. You got so many orders, but you just don't have the funding to buy enough inventory to fulfill. So I think that's like two ends of the spectrum. One is like a lead gen kind of demand problem, but then the other one is the fulfillment. So those are two things I've observed, but I was curious if there's any other really big concerns that you've seen or issues that founders deal with that you often have to help them with.
Yeah, I think And by the way, the example you gave of the inventory is sort of why we started this business.
Yeah.
It's the exact problem that we kept seeing, and people just didn't even understand what demand was out there because they didn't have enough inventory to fulfill it. So that's a great time for us to be investing in those businesses. I would say one of the main things that we're really seeing is that because a lot of like the quote arbitrage of marketing has gone away over the past few years, and companies were so reliant on certain channels, whether that's Facebook or influencer or whatever it might be, they're having a little bit of difficulty adjusting to this new norm of like tying together all of the content, all of the marketing channels, all of the distribution channels, and all of the supply chain into a business that's diversified from all of those standpoints and flexible enough to move all of those product inventory, marketing, content, all those things um, uh, uh, across different channels when it makes sense, right? And so there's the cost of marketing keeps changing across all of the channels. It's becoming a lot more. I would say the overall market's becoming a little bit more efficient, and it's very hard to find those like arbitrage opportunities. So the infrastructure of your business kind of has to be set up so that you can adapt to it and be nimble. With your operations, and so that's something that's difficult. It's difficult to tie all those pieces together, but it's because it's essentially taking each component of your business and making sure that everyone's talking to each other and can move together, and that's something that I think a lot of founders, especially when they're used to they're focused on they built their business in one channel or one thing that was working, now have to think about a dozen other things.
Yeah, and I know this might be a loaded question, but I know there's so many different types of businesses that have so many different growth channels. But I'd be curious to have any high level insights from you in terms of things that the founders are seeing in terms of user acquisition. Are a lot of them doubling down on one growth channel, and if it's working, continuing that, or are they trying to have an omni-channel strategy where they're putting a little bit of budget into Amazon, or some budget into Facebook and Instagram, and are they exploring TikTok? So would love to maybe hear some insights from you in terms of like the growth strategies, and if you got a couple examples with a couple different businesses, like maybe one business uses Amazon versus another business that uses Instagram, would love. And it's only because I kind of nerd out on this stuff.
Yeah.
But love to hear your inputs if you have any.
I would say every company is different, and what works for one company may not work for another. To give you an example, we have a company that's been like very successful on TV, and so had commercials that just resonated with the audience that they were targeting. We had another company that tried TV, it didn't work, and it was basically the same team doing it, and it just didn't work for their audience, their product category. And so I think that the overall strategy of you saying companies double down on things that work, that makes sense to a certain extent, but as I was saying before, like the companies have to be flexible enough to move once they see that it's not working. And all of this really comes down to execution, and so the different people and companies have different strengths, and teams within those companies have different strengths, and so figuring out what works for each company it's an iterative process that's ongoing. It just doesn't stop. So one day Facebook's working, next day TikTok's working. I think one of our advisors last year was saying that there's probably 9 to 12 months of an arbitrage in TikTok. So by now, I would imagine a lot of that's gone away. And you just have to adapt to changing environments, and just be on top of what's going on in the market. So I think there's no panacea. It's sort of everything now seems to be like incremental. You sort of optimize each thing along the way.
No, that's really helpful. Any advice for people that are looking to start their own fund, and maybe any learnings when you were kind of early in your journey, becoming an emerging manager and, building that track record, someone's kind of trying to start from day one. What would you advise them to do?
Have patience.
Mhm.
Expect that it's going to take longer and more meetings than you probably think. But I think a lot of it is just be very communicative. A no today, 6 months down the line may change to a yes. That happened a lot
Mhm.
actually within our investor network. Every investor has something else going on.
Mhm.
Communicate, send updates, build your pipeline, build your relationships, and learn from every meeting. Take
Mhm.
the feedback and ask for it as often as you can. And it's a process. I don't think anyone's
Mhm.
ever said fundraising's been easy. So it's
Yeah.
taken a long time, and whatever you can do to make progress along the way, that's build the processes that you want to
Mhm.
have within the fund, from like your memos to your dashboards to how you're logging companies and opportunities. Just be meticulous about it.
Yeah, and we'll wrap up in a few. If anybody has any questions, just ping it in the comments, and I'll try to call it out. One other thing that I've seen a lot of fund managers do is build kind of these community events. Maybe whether it's a private dinner or kind of a small summit. So I don't know if you guys have kind of explored, community building, but any learnings that you've taken across when trying to build a community. And one thing I'll add too, with your strategy, which I want to applaud you guys on, is the fact that you guys have this network. So you told me that there was one founder that wanted to go on TV because you have that network of experts, that you could plug in that TV expert to kind of see if they can support your other founders as well. So I think that's one huge thing, that network of experts and service providers and even volunteers, like you said, definitely supports the community. And I can see some of those people even probably being interested in being LPs. But along with that, any other things that you've kind of learned in your journey of kind of building community and also probably even more private community events for curated people?
Yeah, before the fund, we had sort of the advisory side of the business,
Hmm.
and we were always building community. And so this network of advisors and experts has reached to over 500, and we do a lot of events. We used to do demo
Hmm.
days. We do a lot of
Yeah.
kind of classes and workshops. We're hosting a workshop next week for our portfolio. And we try to stay as current as we can, and we bring in our experts to teach those classes and interact
Hmm.
with our and engage with our portfolio founders. But I think the one thing that we try to do with community is make sure that the incentive to be part of it and the benefits go all around.
Hmm.
So I think a lot of companies a lot of people kind of view like advisors and experts almost as like there's a one-way street of sage advice coming down to younger folks. But we've always found that the advisors learn just as much, maybe sometimes more
Hmm.
from some of the innovators, and they take it with them to whatever they're
Yeah.
doing. So to encourage that and engage that conversation and that relationship building is something that we found really beneficial to foster what we're doing at Ember.
Yeah. Well, that was amazing. It looks like we don't have any specific additional questions from the audience. So I guess my final question to you, and then we'll wrap up, is just maybe a piece of wisdom or something that you've learned in the last quarter that maybe just kind of going through your work weeks, that you've picked up. If you have a little nugget of wisdom that you've picked up in the last quarter, we'll leave with that.
Um, that's a good question. I guess I'm sure most people do this, especially in your network. But I was listening to a podcast, I think it was yesterday or something, where it was just make sure you're surrounding yourself with other people building things, because
Yeah.
I think that that dynamic is very unique, and
Mm-hmm.
the knowledge that you can glean from just other people going through similar experiences and that you can share with them is super beneficial. So
Yeah.
I know a lot of people still work from home, but like the more you can get out there
Mm-hmm.
to talk to people, and kind of share your struggles, because there's always a lot of them.
Yeah.
It's a good place to vent and learn and be a part of something, as you're growing your business.
Sure. Well, hey, Matt, thanks so much for coming on the show. It was good hanging out with you and Luke a couple of weeks ago, and hopefully we get to catch up soon.
Sounds good. Thanks for having me.
All right. Take care.
Bye.
Bye.